Something happened this week that barely made a headline, and yet it matters more than the decision everyone was watching for. The Federal Reserve met, held rates steady for a fifth straight meeting, and most financial coverage treated that as the story. But while cameras were pointed at the Fed statement, the 30-year Treasury yield quietly climbed to its highest level since 2007. Not since the last time the world was staring down a financial crisis has long-term government borrowing cost this much. And here's the part almost nobody said out loud. The Fed didn't do that. The market did. That distinction is the whole story tonight. And by the end of this video, you'll understand why a number most people scroll past is arguably more important than the decision everyone was refreshing their phone for. Let's start with what actually happened, because the sequence matters. On Wednesday, the Federal Open Market Committee voted 9-3 to leave its target rate unchanged in the range of 3.5 to 3.75%. That's 5 consecutive meetings without a move. On the surface, that reads as stability. A committee that isn't panicking. A central bank comfortable holding its ground. But a 9-3 vote is not unanimous, and it wasn't close to it. 3 members wanted a hike. That's not noise. That's a meaningful minority of policymakers, signaling they think inflation risk is still very much alive, even as the majority chose patience. When a vote splits that way, the market doesn't just hear hold, it hears divided, and division at the policy table tends to get priced somewhere else in a place most casual investors never look. That place is the long end of the bond market, and the day after the Fed's decision, the 30-year Treasury yield pushed up to 5.2%, a level not seen in 19 years. Think about what that actually represents. The 30-year Treasury is essentially the interest rate the United States government pays to borrow money for 3 decades. It's not set by the Fed. The Fed controls the short end of the curve, the overnight lending rate that shapes what banks charge each other and, indirectly, what consumers pay on credit cards and short-term loans. But the long end, the 10-year, the 30-year, that's set by whoever is willing to buy that debt. Pension funds, insurance companies, foreign central banks, everyday bond investors. When their collective judgment pushes the price of a 30-year bond down, its yield goes up because yield and price move in opposite directions. So when you see the 30-year yield climb to a 19-year high the day after the Fed holds steady, what you're really watching is the bond market disagreeing in its own quiet mathematical way with the idea that everything is fine. Here's why that distinction is worth sitting with for a moment. A central bank can announce a policy. It can hold a press conference. It can use careful language designed to project confidence. But it cannot force millions of independent buyers around the world to accept a lower long-term return for lending the government money. If those buyers start demanding more compensation to hold 30-year debt, no speech changes that. The yield goes up until buyers are satisfied, full stop. That's why professional bond traders have a saying that's older than most of them. The Fed controls the short end, but the market controls the long end. And right now, the market is speaking a lot louder than the Fed. So the natural next question is, why would buyers of 30-year Treasury suddenly demand more yield right after a Fed decision that was supposed to be reassuring? There are a few forces at work here, and it's worth walking through them individually because each one tells a slightly different part of the story. The first is what bond investors call term premium. That's the extra return investors demand for tying up money for a long stretch of time instead of a short one, to compensate for the uncertainty of not knowing what inflation, growth, or fiscal conditions will look like decades from now. Term premium has been unusually low for most of the past 15 years, partly because central banks around the world were buying enormous quantities of long-term debt, which suppressed yields artificially. As that buying has faded, term premium has been reasserting itself, and every time it does, long yields drift higher independent of anything the Fed does with short-term rates. What we're watching this week may be another chapter of that same story, not a brand new one. The second force is supply. The United States government has to issue an enormous and growing amount of debt to fund its deficits, and the Treasury Department has been leaning more heavily on longer maturities to do it. Every additional 30-year bond that gets auctioned is one more bond competing for the same pool of buyers. Basic supply and demand applies here just as it does anywhere else. More supply, all else equal, means lower prices to clear the market, and lower prices on a bond mean higher yields. This is one of the quieter mechanical explanations for what's happening, and it's one that doesn't require any dramatic story about crisis or collapse. It's simply arithmetic playing out in a market that has to absorb a lot of new paper. The third force is inflation expectations, and this is where the Fed's own words from Wednesday actually connect back to what happened in the bond market on Thursday. Even in holding rates steady, the Fed chair's comments after the meeting reiterated the committee's commitment to bringing inflation down, which on its face sounds reassuring. But markets don't just listen to the goal, they listen to the path. If investors read those comments and conclude that getting inflation fully under control will take longer than previously hoped, or that the path there involves tolerating higher prices for a while longer, they'll demand more yield on long-dated bonds to protect the real value of their investment over 30 years. That's not panic. That's just bond math responding to a slightly less certain inflation outlook. Now here's where the story gets more interesting, because the very next morning on Thursday, the data that matters most to the Fed's own thinking was released. The Core Personal Consumption Expenditures Index, the inflation gauge the Fed itself says it watches most closely, came out. That report landed 8 hours after the rate decision, and in some ways it was always going to be the more consequential number of the week, even though far fewer people were watching for it. Central bank decisions get press conferences. Inflation data gets a data release and a chart. But if that inflation print came in warmer than expected, or showed stickiness in categories the Fed cares about, that alone could explain a meaningful chunk of the yield move. No grand theory required. This is worth pausing on because it illustrates something important about how modern markets actually digest information. The headline event, the Fed decision, gets the spotlight, but often the real signal arrives in the data that follows almost as an afterthought in casual coverage. If you were only watching the Wednesday headlines, you would have walked away thinking the story was Fed holds steady, markets calm. If you were watching Thursday's yield move and the inflation data behind it, you'd have a very different and probably more accurate picture of where the market's head actually is. So let's bring this back to the original question and to gold and silver, because that's ultimately why most people watching this care about any of it. The textbook relationship between interest rates and gold is fairly simple, and it's worth explaining clearly before complicating it, because the complication is exactly what's interesting right now. Gold doesn't pay interest. It doesn't generate a dividend. Its only return, in a traditional sense, comes from price appreciation. That means the opportunity cost of holding gold rises when interest rates rise because you're giving up a known safe return elsewhere to hold an asset that pays you nothing directly. Economists usually frame this in terms of real interest rates, meaning the nominal yield minus expected inflation, because that's the rate that actually reflects the true cost of parking money in a non-yielding asset like gold. When real yields rise, the textbook says gold should struggle. When real yields fall, gold typically has room to run. Given that the 30-year yield just hit a 19-year high, the textbook would predict gold should be getting hit hard right now. And yet, gold is trading near $4,100 an ounce, a level it's held with relative stability for roughly 2 weeks. And it actually firmed up somewhat after the Fed's decision rather than falling apart. That's the contradiction worth sitting with. Rising long-term yields and a gold price that isn't collapsing under the weight of them. When the textbook and the market disagree, that's usually the most useful place to look because it tells you something is happening that the simple model doesn't capture. A few explanations are worth laying out here, and it's important to treat them as competing hypotheses rather than settled fact because nobody, including seasoned professionals, knows with certainty which one dominates at any given moment. The first is that a firm U.S. dollar is currently offsetting some of the pressure that higher yields would otherwise put on gold. The dollar has been sitting near a 1-month high, and because gold is priced in dollars globally, a stronger dollar makes gold more expensive for buyers using other currencies, which normally suppresses demand. If the dollar strength is partially the result of exactly the same yield story we've been discussing, foreign capital flowing toward higher yielding U.S. debt, then you have two forces pulling in opposite directions on gold at the same time, higher yields pushing it down. Dollar-driven demand shifts pulling it in different directions depending on the buyer. The net effect can look like gold simply trading water, which is roughly what we're seeing. The second explanation involves what's happening well outside the bond market entirely in the Middle East. Renewed military activity between the United States, Iran, and their respective allies has been an ongoing undercurrent through much of this year, and it tends to put a floor under precious metals regardless of what interest rates are doing. Safe haven demand doesn't care about opportunity cost calculations. When investors are worried about geopolitical escalation, some capital moves into gold simply because it's gold, a store of value with a multi-thousand-year track record that has nothing to do with yield curves. If that geopolitical floor is currently strong enough to counterbalance the drag from rising yields, you'd expect exactly the kind of sideways stability gold has shown. The third explanation is structural and slower moving, but arguably the most important one over a multi-year horizon, sustained central bank buying. Over the past several years, central banks around the world, particularly outside the traditional Western financial system, have been accumulating gold at a pace not seen in decades. This isn't retail investors chasing headlines. It's sovereign institutions making long-term reserve allocation decisions, and those decisions tend to be far less sensitive to a single quarter's interest rate move than private investors are. If a meaningful and growing share of gold demand is coming from buyers who are not making the trade based on this week's yield chart, that demand provides a kind of underlying support that didn't exist as strongly in previous decades, when gold's price action was more purely a function of Western real interest rates. It's worth being honest here about what we don't know. We can't say with precision how much of gold's current stability is dollar dynamics, how much is geopolitical hedging, and how much is structural central bank demand. Reasonable analysts disagree on the weighting. What we can say is that the relationship between yields and gold has visibly weakened compared to how it behaved in past decades, and that weakening is itself a meaningful data point regardless of which explanation you find most convincing. Now let's turn to silver, because silver's story this week is different enough from gold's that it deserves its own explanation, and it connects to something almost entirely separate from anything the Fed did. While gold held roughly steady, silver actually rallied, gaining around 0.5% to trade near $58 an ounce, recovering a chunk of a sharp pullback from earlier in the week. That's notable on its own, but the more interesting detail is what it did to the gold to silver ratio, a number that tells you how many ounces of silver it takes to buy 1 ounce of gold. That ratio compressed from just over 70 down to roughly 69. A falling ratio means silver is outperforming gold, and traders watch this relationship closely because historically, when silver starts to outpace gold, it often signals that investors are shifting from a pure safe haven mindset into a more growth-oriented industrial demand mindset, since silver, unlike gold, gets used heavily in manufacturing electronics and increasingly in solar panel production. And that industrial angle brings us to what might be the single most important structural fact in the entire precious metals conversation right now, one that has almost nothing to do with the Fed, the dollar, or Treasury yields. According to the Silver Institute's most recent survey, the silver market is on track for its 6th consecutive year of a supply deficit, meaning global demand is expected to outstrip mine and recycled supply by more than 46 million ounces this year alone. 6 straight years of deficits is not a blip. It's a structural imbalance that has been building for the better part of a decade, driven by surging industrial demand from electric vehicles, grid modernization, and solar infrastructure, categories of demand that don't particularly care what the 30-year Treasury yield is doing. This is worth dwelling on for a moment because it changes how you should think about silver compared to gold. Gold's price behavior is still heavily influenced by macro forces, interest rates, the dollar, central bank reserve decisions, geopolitical risk. Silver responds to those same forces, but it's also sitting on top of a genuine physical supply and demand imbalance that operates on an entirely different timeline. A rate cut doesn't create more silver mines. A dovish Fed statement doesn't reduce the amount of silver an electric vehicle factory needs. That structural deficit is, in the language of long-term market analysis, a floor that doesn't respond to short-term monetary policy shifts, even though short-term monetary policy can absolutely still move silver's price around in the meantime, sometimes violently, as we've seen with silver's recent swings. It's worth being clear about the difference between these two forces, because conflating them is one of the most common mistakes casual investors make. The macro story: rates the dollar, Fed policy tends to drive short-term price swings, sometimes large ones. The structural story, the supply deficit, tends to shape the multi-year floor beneath the price. Both matter, they just operate on different clocks, and confusing a short-term macro wobble for a structural shift, or vice versa, is how a lot of investors end up making decisions based on the wrong time horizon. Let's zoom out now and put some historical context around this 19-year high in the 30-year yield, because history doesn't repeat exactly, but it does offer useful comparison points as long as we're careful not to overstate them. The The last time the 30-year yield traded anywhere near this level was in 2007, in the period just before the global financial crisis fully unfolded. It's tempting, and frankly a little irresponsible, to draw a straight line from yields this high once preceded a crisis to yields this high now means a crisis is coming. That's not how history actually works, and any honest analyst has to resist that temptation. The conditions in 2007 were shaped by an entirely different set of problems. A housing bubble built on questionable lending standards, enormous leverage hidden inside complex financial instruments that few people fully understood, and a banking system with far less capital cushion than it carries today following more than a decade of stricter regulation. None of those specific conditions are the dominant story in 2026. So the comparison isn't, this is 2007 again, the comparison is narrower and more useful than that. It's a reminder that the last time long-term borrowing costs sat at this level, it reflected a market pricing in serious uncertainty about the future, and it's worth asking honestly what kind of uncertainty the market might be pricing in today, even if the specific cause looks nothing like last time. What might that uncertainty be today? A reasonable case can be built around persistent fiscal deficits and the sheer scale of government debt that needs to be refinanced and issued in the years ahead, combined with a Federal Reserve that a meaningful minority of its own policymakers believe still hasn't fully tamed inflation. That's a different flavor of concern than a housing bubble, but it's still a form of the market saying, we're not entirely comfortable lending money for 30 years at the rate you're offering, so we want more compensation. Whether that concern proves justified or overblown is something only time will answer. The point right now isn't to predict the outcome. It's to recognize that the yield itself is the market's honest, real-time vote on how much risk it perceives, a vote that doesn't require a press conference or a policy announcement, and one that has quietly been recast this week at levels not seen in 19 years. Let's talk about who this actually affects, because it's easy to treat a Treasury yield as an abstract number on a financial news chart, but it touches real financial decisions almost immediately. Mortgage rates in the United States are closely tied to the 10-year Treasury yield rather than the 30-year, but the two tend to move together, and a broad rise in long-term yields tends to push mortgage rates higher as well, making home financing more expensive for anyone buying or refinancing. Corporate borrowing costs are affected too. When the government has to pay more to borrow for 30 years, corporations issuing their own long-term debt typically have to offer even higher yields to compete for the same pool of capital, which raises the cost of financing for everything from new factories to expansion plans, and pension funds and insurance companies, many of which hold enormous quantities of long-duration bonds to match their long-term liabilities, see the value of their existing bond holdings fall when yields rise. Since bond prices and yields move inversely, that's a real, immediate wealth effect on some of the largest pools of capital in the financial system. Even if it doesn't show up in a headline about the stock market the way an equity sell-off would. So who benefits from this environment and who's more exposed? Savers holding new fixed income, people buying Treasury bonds or CDs today, actually benefit from higher yields, since they're now being offered a better return for lending their money for a long period than they would have been a year or two ago. That's an underappreciated silver lining for conservative, income-focused investors, particularly retirees who rely on interest income. On the other side, anyone holding existing long-duration bonds purchased when yields were lower is sitting on paper losses, because those older bonds are now less attractive compared to newly issued ones offering higher rates. Anyone planning to borrow for a home, a business expansion, or major capital investment is facing a more expensive borrowing environment than they would have a year ago. And precious metals holders are watching a genuinely mixed picture, a headwind from rising real yields, but apparently enough offsetting demand from dollar dynamics, geopolitical hedging, and central bank buying to keep gold roughly stable and silver actually advancing. This is a good moment to lay out the three scenarios that professional market participants tend to think through in a situation like this, because no single narrative captures everything, and intellectual honesty requires holding more than one possibility at once. The bullish case for precious metals rests on the idea that the yield spike we're seeing is more of a supply and term premium story than a runaway inflation story, and that as new Treasury issuance gets absorbed by the market over the coming months, yields could stabilize or even retreat, particularly if upcoming inflation data comes in cooler than expected. In that scenario, real yields would ease, reducing the opportunity cost of holding gold, while silver's structural supply deficit continues, providing underlying support regardless of what rates do. Combine that with ongoing central bank gold buying and any continuation of geopolitical tension, and you have a case where both metals could see renewed upward momentum, especially if the dollar weakens as part of that same shift. The bearish case takes the opposite read. If the yield move reflects genuine, sustained concern about inflation staying stubbornly elevated, and if the Fed's own internal split, remember 3 members wanted a hike, turns out to be an early signal that policy could tighten further later this year, then real yields could continue climbing. That would increase the opportunity cost of holding gold meaningfully, and it's worth remembering that gold and silver already experienced sharp corrections earlier this year, falling more than 20% and 35% respectively from their highs during the height of the U.S.-Iran conflict, before recovering a substantial portion of those losses. That earlier drawdown is a useful reminder that these are not one-way markets, and a continued rise in yields, especially if paired with a stronger dollar and reduced geopolitical tension, could open the door to another leg lower. The neutral or base case, and honestly the one that current price action seems to be leaning toward, is a period of consolidation, gold holding in a fairly tight range as competing forces roughly offset each other, and silver continuing to be shaped more by its own structural supply story than by the broader macro tug of war. In this scenario, the more important developments to watch aren't dramatic headlines, but the quieter data releases how upcoming Treasury auctions are received by buyers, whether demand is strong or weak, what the next inflation reports show, and how the odds shift for the Fed's September meeting, where markets are currently pricing meaningfully higher odds of a rate cut than they were pricing for this most recent meeting. Which of these 3 cases currently has the most support from available evidence, based purely on what we know as of this week? The neutral case looks best supported. Gold stability despite rising yields suggests offsetting forces are currently in rough balance rather than one side clearly dominating. Silver's structural deficit provides a foundation that isn't going anywhere regardless of near-term rate moves. And the size of the yield move, while genuinely significant and worth taking seriously, isn't yet dramatic enough on its own to declare a decisive break toward either the bullish or bearish extreme. That could change quickly with new data, and it's worth being honest that markets can shift from consolidation to a clear directional move faster than most participants expect, but as of right now, balance rather than a decisive breakout looks like the most defensible read of the evidence. There's a broader lesson buried inside all of this that's worth naming explicitly because it applies well beyond this particular week's news cycle. Financial media, and honestly a lot of financial content built for quick engagement, tends to gravitate toward the loudest, most scheduled event, the Fed decision, the press conference, the headline number. Those events matter, but they're often not where the most important information actually lives. The bond market, quietly repricing 30-year debt to a level not seen in 19 years the very next morning, was arguably saying more about the state of long-term economic confidence than the Fed's carefully worded statement did. Professional bond traders and portfolio managers know this instinctively, which is why many of them pay closer attention to Treasury auction results and yield curve movements than to the press conference itself. Auction demand, in particular, is one of the more useful leading indicators available because when the Treasury sells new bonds, the ratio of bids received to bonds offered, along with the yield those bonds clear compared to expectations going in, tells you in real time whether buyers are confident or reluctant. A weak auction, one where the Treasury has to offer meaningfully higher yields than expected to attract enough buyers, is one of the more honest signals available about market sentiment, because it isn't filtered through a press release. It's simply what buyers were actually willing to pay. So what should different types of investors actually be watching from here, understanding that none of this constitutes specific financial advice, but rather a framework for where to direct your attention? If you're a first-time investor just starting to pay attention to markets, the most useful habit to build right now is distinguishing between short-term policy headlines and the underlying yield and inflation data that often matters more. Get comfortable checking where the 10-year and 30-year yields are trading, not because you need to trade around them, but because they're a genuinely useful barometer of what the broader market believes about long-term risk, arguably more useful than any single Fed statement. If you're a retiree or someone relying on fixed income for a meaningful part of your financial life, this environment of higher yields on new bonds is worth understanding clearly, since it means newly purchased Treasury securities or CDs are currently offering better income than they were a year or two ago, even as older. Lower yielding bonds you might already hold have lost some market value in the interim. Understanding that distinction between the yield available today and the paper value of what you already own matters for how you think about your portfolio. If you're someone who holds precious metals, either physically or through funds, the more useful thing to track isn't the day-to-day price swing, but the underlying forces we've walked through: real yields, dollar strength, central bank buying trends, and for silver specifically, the ongoing supply deficit reports that come out periodically from industry sources. Those structural indicators tend to tell you more about where the multi-year trend is likely headed than any single day's headline. And if you're an active trader, the specific things worth watching in the coming weeks are the results of upcoming Treasury auctions, the next round of inflation data, particularly the core PCE reading, since that's the gauge the Fed itself weighs most heavily, and how market implied odds for the Fed's September meeting evolve as new data arrives. Those 3 data points, more than almost anything else, are likely to determine whether the yield story we've discussed today continues, stabilizes, or reverses. It's also worth acknowledging honestly what assumptions could turn out to be wrong here, because that kind of intellectual honesty is what separates useful analysis from confident guesswork. It's possible the yield spike proves temporary, driven by a single week auction or a short-term supply imbalance that resolves itself within weeks, in which case much of what we've discussed today would prove to be noise rather than signal. It's also possible that the offsetting forces currently supporting gold, the firm dollar, geopolitical tension, central bank buying, shift simultaneously, in which case gold's apparent decoupling from rising real yields could reverse abruptly, and a more traditional inverse relationship could reassert itself quickly. Markets have a long history of humbling anyone who declares a new paradigm with too much confidence, and the honest position is to hold these explanations as reasonable, evidence-supported hypotheses rather than settled conclusions. Let's bring this all the way back to where we started. The Federal Reserve held rates steady this week, and on the surface, that looked like the story, but the real story arrived the next morning. In a bond market quietly pushing the cost of 30-year government borrowing to its highest level in 19 years, that's not a policy decision. It's millions of independent judgments made by buyers all over the world, collectively expressing something the Fed's own statement couldn't fully capture. A degree of uncertainty about inflation, about fiscal sustainability, about the path ahead that the market is choosing to price in whether the Fed acknowledges it or not. Gold's relative calm in the face of that move, and silver's continued strength on top of its own structural supply deficit, suggests that precious metals investors are currently weighing a more complicated set of forces than a simple interest rate story would suggest. Forces involving the dollar, geopolitics, and central bank behavior that don't always show up in a headline. Whether that balance holds, tips bullish or tips bearish from here will likely be decided not by the next Fed meeting, but by the quieter data in between auction results, inflation prints, and the slow accumulation of evidence about whether this week's yield move was a passing ripple or the start of something more lasting. Here's the question worth sitting with after this video ends. The Fed controls the interest rate that makes headlines, but the market controls the interest rate that actually shapes mortgages, corporate borrowing, and the long-term value of money. When those two signals start telling slightly different stories, which one do you think deserves more of your attention going forward? If this kind of analysis is useful to you, consider leaving a like. It genuinely helps this reach more people who are trying to understand markets clearly rather than reactively. And if you want to keep pulling on this thread, there's another video linked right here walking through exactly how central bank gold buying has been reshaping this market over the past few years, which connects directly to some of what we touched on today. Thanks for watching this one all the way through.